Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schafer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are not financial advisors. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guest is not formal advice or a recommendation. Now please enjoy this episode.
Okay, welcome in. This is the Fundamental Analysis Show on Chit Chat Money, and I am here with Ryan Henderson as always. Ryan, how you feeling today?
I'm feeling good.
Nintendo's going lower, so
I know,
happy
this
day,
is
right?
good. Yeah, buy low. It's like gas prices, right? The whole
Yeah.
Buffett thing. You know?
Yeah. Always good, always better. But we're talking about Goodfood Market Corp. They are an under-the-radar company, actually under $1 billion in market cap. So I'm going to let you get into what they do and then the history of the company.
Goodfood Market Corp is a Canadian online grocery, home meal, and meal kit company. So they put their mission as, they said their mission is to make the impossible come true. That's like the biggest red flag.
It is a red
What
flag,
even?
yeah.
What does that even mean?
It
Like,
reminds
why can't you just say our mission is to deliver food and get profits?
Yeah, well, it also think about that. That feels like Peloton's mission. That could be they could put that for Peloton's mission, and I'd be like, okay, that's Peloton, I guess. But
That could be any business.
company. Yeah, Costco. Our mission is to make the impossible come true. Hot dogs for $1.50.
Like, it shouldn't be this hard to describe your own business. Like, just tell us what you actually do. But anyway, so from the customer
Yeah,
side,
go on.
you subscribe to Good Food and you get delivery of fresh food directly to your home. So it isn't just people. You might be thinking of Instacart. It's not like that. It's not just people bringing you food from the grocery stores. Good Food they have direct relationships with suppliers, so farms, stuff like that, for the fresh groceries. And then they also have meal kits that are prepared at some of their production facilities, if I'm not mistaken. And that's all delivered directly to you. They also have partnerships with delivery companies, but they're building out a last mile delivery service called Good Courier. So that's their own part. So they're trying to sort of basically build the entire infrastructure and not just be a middleman.
Yeah, they're not trying to just arbitrage like the difference between what someone pays at the grocery store, because that seems just kind of it's kind of like DoorDash, where you're like, this is really good business model. This is a little more interesting. Still don't know if it's gonna work, but it's kind of cool that they're trying to vertically integrate like that.
A little bit about the history. Good Food was established in 2014, so really recently, by Jonathan Ferrari and Neil Cuggy. I think I'm getting that right, under their first name, Culiniste. The service grew pretty fast and was helped along by Anne-Marie Withenshaw, a Canadian television and radio personality. Don't know who that is.
Hey, we got a good Canadian audience, so
They
might know what that is. So it's like 6% of you guys out
All
in
right.
Canada. You probably know who these people are.
So she apparently advocated for the product in its early years, and then 2 years after being established, they changed their name to Good Food and went public on the Toronto Stock Exchange in 2017. Question: do you like Culiniste or Goodfood Market Corp better?
Goodfood Market Corp's better because I think it's really when they're actually like going to consumers, it's just good food. And that's definitely better than Culiniste.
I don't know. Culiniste's got a ring to it.
What ring?
You know, it's kind of got some pizzazz.
Yeah.
Anything with East Day at the end.
Maybe. If it was Culinify, then I would invest. But
Okay.
their
Valuation.
enterprise. I'll get into the valuation. They have an enterprise value of $468 million. So not a large company at all. And it's kind of getting closer to the bottom of the small cap there. Ticker is FOOD, and then is a Canadian company, like you said. So look for the actual ticker if you're going to invest in whatever country you're in. But
It's
we
probably
have big, like United States is going to be food.ca or maybe food. Whatever the
TO.
Toronto TO for Toronto Exchange. Just look for that. Their stock price on the Toronto Exchange, I believe, is about $9.29, but really that's irrelevant. And that number, some of these numbers, if they're on here, they may be listed in Canadian dollars. It's like a 3/4 of what a US dollar is. It's just a little different. So when you're actually going through the analysis, make sure either to convert it or just know that there's going to be that slight difference.
Yeah, and if you're on most of the like Koifin or stuff like that, it's already converted for you. So.
Yeah, so this is mainly if you're looking at earnings numbers and stuff like that. So their EV to sales is 2.5 on the last 12 months, gross margin 28.8%, EV to gross profit of 8.68, so fairly low, margin adjusted EV to sales of 11.74, and that's what we do when we take EV divided by sales growth and divided by gross margin to get an overall look of what a growth company is trading at.
It's really low.
Really, really low, but it kind of makes sense that it's this low because they had a abnormal bump in sales growth because of the pandemic. A lot of people doing grocery delivery and meal kit delivery to try to, socially distance. So, that makes sense, but typically, even if growth slows, they'll still be, relatively fine if growth slows to like 20, 30%.
By the way, before this, they were growing revenues in the triple digits.
Right? Oh, really?
Yeah, it was like 120%, something like that. And so it's declined, but they said they're still seeing a bit of an acceleration.
Yeah, and I think that has to do with marketing spend, but that's not something we have we can't look at that. So they're saying that on their internal metrics, their marketing spend or whatever, their unit stuff, but as an outside investor, you just have to take their word for it. They have no dividend, $30 million in working capital. If we look at the balance sheet, $12 million in long-term debt, and $23 million in convertible debentures. And I think the strike price on that is around $4.50. So as long as the stock price doesn't go down by 50%, that debt should convert into stock. $21 million in leases outstanding, so nothing concerning on the balance sheet. And then their shares outstanding have gone up from 56 million to 57 million in the last year. Again, nothing too crazy. With that, we're just kind of looking for, all right, are they diluting the shares by like 20% a year or something like that?
Right. I'll get into the earnings. As of the third quarter for 2020, they had 272,000 customers, growing at about 44% year over year. They had 179.3 million in trailing 12-month revenue. That's up 76% year over year, so growing pretty fast. And then in the most recent quarter, they had around 28.8% gross margins. Their adjusted gross margins are more like 40%. And then they were profitable in general, but they've pretty much been around break even for a long time. But this quarter they were profitable. Their adjusted EBITDA margin was roughly 7%, 10% operating cash flow margin, positive net income for the quarter, but I think it was like a net margin of less than 1%, so right above profitability. Mm-hmm. They had $61.2 million in cash and cash equivalents, so if they're not at any sort of burn rate, that's enough liquidity to last them for a while. Mm-hmm. And it's a very seasonal business, so the summer months make up only about less than 18% of trailing 12-month revenue. So it's a business that really makes a lot of their money, and that is, keep in mind, that is during COVID. That month, quarter didn't make up that much. So they make a lot of their money in the winter months and spring as well. Yeah,
this holiday season especially will be interesting to watch, especially with COVID plus that winter boost they typically get. But we're going to hit the ad break, and then we're going to come back for the second half of the show. Okay, welcome back. First segment is Digging Trenches, which is our 0 to 3 rating on the moat. Tough for this business because it's kind of young, but I think I'd give them the way they're going about it, and maybe like a 0.5 or 1, but they don't have a moat yet. If they succeed and build out what they're doing, they could have a moat just from an economies of scale, sort of like how Walmart had it, although that's a big comparison, but that's the easiest one. Maybe more like Kroger back in the day.
I might go
for the delivery.
I might go a little higher. I might go like a 1.5 because they are really. I mean, they're. You've seen probably the infomercials of like the come get these free meal kits, or whatever, and so they're not that kind of business. And then they're also not just the go pick it up in the grocery store for you.
That's just VC money getting burned, right?
They've built out a real supply chain and they've become a good business, and that is very capital intensive to do. And they've had, fortunately, a great catalyst in the pandemic. So not a lot of companies are going to be able to get a boost like that and be able to build out the infrastructure that Goodfood has. I think food delivery in general is a hard business to do, but if you do it right, you can be sort of isolated.
Yeah. It takes a unique business model. You got to go at it with a different angle. You can't just say, all right, I'm going to be a food delivery business. Well, I mean, that's very repeatable. Yeah. So let's get to future growth opportunities. Why don't you go first?
Yeah, so just continuing to expand their logistics infrastructure. Right now they're building out 2 production facilities in the greater Toronto area, one of which is already operational, so they're working on the second one. They've been opening and ramping up the Vancouver Fulfillment Center, and they've also ramped up their Good Courier service, which 1/3 of all customer orders were delivered through their Good Courier service. And apparently that makes it much easier. Delivery costs come way down. It makes it much easier on the customer experience because delivery comes a lot faster. It said in order for them to be able to do same day and 1 day delivery, they're going to need to rely on this Good Courier service a lot.
Yeah, that's another example of them trying to vertically integrate, not trying to rely on third parties, and that might be more expensive up front, but hopefully it can increase their margins down the line. My future growth opportunity is Goodfood Wow, and they have it in all caps here. I'm not sure if that's how they market it, but it's just WOW, all caps. This is their new unlimited same-day grocery delivery that's starting in the Montreal area, so it allows any member to order any combination of meal kits, groceries, and prepared meals. So I think that's a good idea where they're trying to show that, all right, we're not just meal kits, we're not just grocery delivery. You can combine everything and kind of maybe get a hot meal and then some of your produce, some of your consumer staple stuff. And then if you're a member of this, you get same day delivery and you get free delivery, and it costs $10 a month. Kind of like the Prime offering. I know everyone says this is our Prime offering, but I think it makes sense here, and it kind of. Do you think that will differentiate themselves at all? I guess we'll have to see what the numbers say, but...
Yeah, it's like... So, I've never been a fan of Amazon Fresh. Is that their Amazon delivery service or whatever?
Yeah.
I think this has the potential to sort of be the Amazon of food delivery.
At least in Canada.
Right. And it's a very ambitious goal, but they're going at it, I believe, in the right way. And having that last mile logistics service helps. And then... Yes, if you have a lot of loyal customers, I see no reason why you shouldn't do a membership. Like, I'm sure people are more than willing to pay $10 a month to get the food on same day.
Mm-hmm. Yeah, I think looking at it just internally, like not internally, but just personally, it makes sense because I think the big concern with delivery services is, all right, I got to pay this fat fee for these groceries to get delivered. It wouldn't be that hard to go pick it up at the store. Right. But yeah, maybe this can help them create that competitive advantage. Last segment we have is highlights and lowlights. What do you have?
Yeah, so the vertical integration is a big differentiator. That's a highlight for me. I think that this can be a big business, and they are getting a bump, and so you have to sort of determine what the staying power of those customers is, because if the pandemic starts to basically go away or there's a vaccine or whatnot and people are going back to the grocery stores, have they gotten to the point now with Goodfood where they're like, I'll just order everything on Goodfood, I don't need to go back to the grocery store? Or is it because they're still afraid to go out? You kind of got to determine that. But if it is more of an acceleration of the inevitable and it is going to propel them faster into the future and growing much faster as opposed to just a temporary shift, this is going to be a good business, and it's selling at a good price. Mm-hmm. Lowlights for me, though, they are very dependent on bad weather. So their marketing, order rates, and new subscribers are all really low in the summer months. And so I believe it's because people in Canada just don't want to go outside in the winter, and so they get their stuff delivered, which is fine. That works in Canada, but it doesn't bode well for international expansion because... if they're saying basically that in the summer months people will just go to the grocery store.
Well, the thing is, they're not saying that no one's using it, so I think the usage rate just might be a little lower if they expand south to the United States or Europe. So it doesn't mean the business is not viable in the summer. It just means that they get a bump in the winter. So it's not like things are going bad for them.
Yeah, but is the business sustainable if it was just the summer numbers, essentially,
they'd be a lot earlier in their business growth.
Maybe they just expand into Scandinavian countries or only cold weather places.
Hey, there's a lot of people that live in Canada, and there's a lot of people that live in cold weather places, so I don't think this is a problem they're going to run into anytime soon.
All right, what's your highlights and lowlights?
Okay, SG&A as a percentage of their revenue went from 34% to 23% last quarter. So I think there's a lot of strong leverage there. Obviously, they got that inorganic boost from the coronavirus that won't be repeated. At least, let's hope. Yeah. Operating cash flow is positive, and stock-based compensation is not egregious. So I think that shows that they're generating cash without just financing everything by diluting shares. They have 300 exclusive private label products. That was a little redundant in their note because exclusive and private label,
Yeah.
You know what I mean? But they're showing they're making strides, though, with that vertical integration. Like you mentioned, they have the last mile delivery service that now serves 1/3 of their customers solely in the Montreal area right now, but still good. And if it helps reduce costs and improves shipping times, that, provides more value to the consumers and then helps Goodfood be more profitable. So that's a win-win. Low light for me is these type of business models have a history, at least over the past decade, of not working out at all. And they have typically terrible unit economics, but Goodfoods look better. So my concern here is Blue Apron. It's just Blue Apron. Like, they were just a terrible business. Instacart, DoorDash seem like bad businesses, and Goodfood could be a good business, but they're going up against a lot of historical evidence that says otherwise.
Okay. Are you more or less interested in the business today than you were yesterday?
I am more interested if it was just Instacart or if it was just Blue Apron and not the combo plus trying to do it in-house, having their own fulfillment centers. I would be less interested because I'd be like, all right, the unit economics don't work. But I think I'm more interested because, one, people are discounting these type of businesses simply because all of them, not all of them, but a lot of them have failed and gone to zero in the past. But that means a lot of people aren't looking at them. That means the valuation is a lot lower, which we're seeing there with the sales ratio. So there could be some value here. I've just looked at them. I got to do a lot more research, but I'm more interested for sure.
Yeah, I'd agree with you there. I think the prior failures in this industry have led to a largely inefficient market, or because people think everyone's just going to repeat what Blue Apron did, or they're just going to end up being a place where VC dollars get burned.
Yeah.
But that doesn't look like that's what Goodfood is. I mean, Goodfood has proven that they can be profitable. Obviously, they're not like an 80% margin software business, but they can definitely reach scale and they can deliver food for a lot of people. It does feel a bit like a young Amazon story, but just specifically in the food market.
Yeah, so maybe more. Gosh, I'm trying to think of some other.
And I feel like a lot of people say that anytime you deliver any product digitally or you do it like an e-commerce business, everyone says it's going to be Amazon. But they are actually building out the infrastructure and the logistics and having the private label brands to be able to do it well.
Does this remind you of, let's say, Revolve Group or Stitch Fix? A little bit, but with obviously their food, Goodfood's food.
A bit like Stitch
clothes,
Fix, but except they're not like, I don't want that carrot, I'll give it back.
Yeah, it's a little different, but it's similar where they're trying to create that e-commerce model, but more niche, so they can kind of attack maybe Amazon because they're focused on that one product.
Right.
All right, well, that's going to do it for this episode. Thank you guys for listening. Make sure to follow us, as always, on Twitter and just DM us or just add us on there for any suggestions for new shows. And remember, as always, we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Thank you all for listening to this episode. We will see you next Sunday.